Apple's been asked to cough up to the tune of $14.5 billion in the biggest bill in unpaid back taxes in European history. The EU antitrust regulator said that Apple's tax deals with Ireland, which allowed the company to pay very little tax on income earned throughout Europe, breached EU state aid laws, with serious repercussions.
So, what are the consequences of this decision for Ireland and for Apple? To restore fair competition, Apple must recover up to 13 billion euros in unpaid taxes from Apple, plus interest.
The decision comes on the back of years of investigation into corporate tax avoidance. EU authorities say that rulings made by the Irish government in 1991 and 2007 allowed Apple to minimise its tax bill in Ireland. Apple was able to limit its tax liability by using subsidiary companies that conducted business with each other. So sales from European companies would be funneled through Apple's subsidiary in the Irish Republic, which has a lower rate of tax. That meant Apple had a smaller tax liability. And from there, the money would be indirectly sent to tax havens, like the Marshall Islands. It meant countries were deprived of the full rate of tax that would normally be expected. But Apple's own bank balance swelled. Well, it doesn't matter that you buy your iPhone here in London or indeed elsewhere in Europe. The profits from these sales are recorded in Ireland. Now, today's decision paves the way for other EU countries to possibly look at this and say, actually, Apple should have recorded the sales in their country and request that Apple pay them back taxes too. Now, if that happens, the EU Commissioner said today that that big final bill that Apple is requested to pay back to Ireland will be reduced. Ireland's finance minister has said he disagrees profoundly with the ruling, and both Apple and Ireland have said they will appeal against it. There are concerns that the scale of the sum involved might scare US companies from investing in Europe.
I think it's a very sour time for relations in terms of trade between the ES and the EU, and I would say this would only just make things worse because US companies obviously want to invest and grow in Europe, but how are they going to know to what extent they should do that if there's always a retroactive cash grab around the corner potentially from the EU if they're not happy with how much tax is being paid?
But the EU Commissioner said this was not a penalty, but unpaid taxes to be paid. It will now be up to the Irish authorities to calculate exactly what's owed. Sara Firth, TRT World, London.